Welcome to InvestorHubX.com. Have you ever noticed the market doesn't just move randomly, it reacts at the same levels again and again? What if those levels aren't random at all? What if they're based on a pattern that exists in nature, in art, and even inside your own body? In this video, we're going to explore one of the most powerful tools in technical analysis, Fibonacci retracement. First, we'll break down what Fibonacci actually is. Then, we'll dive into how Fibonacci shows up in the markets and why price seems to respect these levels over and over again. After that, I'll show you exactly how to set up Fibonacci on your chart, step by step. We'll also uncover the key Fibonacci levels that traders around the world are watching. And finally, we'll answer the big question: why does Fibonacci actually work in the market? Let's begin. Have you ever noticed secret patterns exist everywhere around us? In the waves of the ocean, in the spirals of a sunflower, and even in distant galaxies. These patterns aren't random. They follow a hidden structure, a hidden code that governs growth, balance, and beauty. This pattern is called the Fibonacci sequence. It appears in architecture, in paintings, and in some of the most beautiful designs ever created. It's like a blueprint behind how things grow and how they are formed. The sequence itself is simple. Each number is just the sum of the two numbers before it. But here's where it gets interesting. When you divide a number by the number that follows it, you start to uncover something powerful. As the sequence continues, the ratio gets closer and closer to a single number, 0.618. This number shows up again and again throughout nature, art, and even the financial markets. In trading, Fibonacci is commonly used through a tool called Fibonacci Retracement. This tool helps traders identify areas where price may temporarily pull back before continuing in the original direction. Because markets rarely move in a straight line, even in a strong uptrend, price often rises, pulls back, and then moves higher again. And in a downtrend, price often drops, bounces, and then continues lower. The question is, how far will the pullback go? This is where Fibonacci comes in. The most commonly used Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These levels are drawn between a major swing low and a major swing high in an uptrend, or from a swing high to a swing low in a downtrend. Once the tool is placed on the chart, it creates a series of horizontal levels. These levels act like potential areas of support or resistance. In other words, places where price might react. So how to set up Fibonacci retracement tool? Click Fib Retracement on the left. On the chart, click once and drag your mouse onto the right. Then click again to lock it in. These numbers next to the lines are your Fib levels. To apply Fibonacci retracement in an uptrend, start by identifying the lowest point of the move, the swing low. Then, click on that point and drag the Fibonacci tool all the way up to the highest point, the swing high. Once applied, you'll start to see the key retracement levels appear on your chart. And notice this: price doesn't just move randomly. It often reacts at these levels, around 0.236, 0.382, and 0.5. These levels can act as areas of support, where buyers step back into the market. The market pulls back, but not randomly. It respects structure. Now, we understand how to draw the fib levels. Let's have a look at the value zones. The 50% level is often seen as a strong level because it represents a deep pullback in the trend. The market has corrected significantly, but the overall trend is still intact. Now, the zone between 50% and 61.8% is where things get interesting. This area is often considered a high probability entry zone where smart money begins to step in. And then we have the 61.8% level, often called the golden ratio. This is considered an excellent level because it represents a very deep pullback, but one that still holds within a healthy trend structure. Now, let's apply Fibonacci retracement to a downtrend. This time, we do the opposite. Start by identifying the highest point, the swing high. Then, click on that point and drag the Fibonacci tool down to the lowest point, the swing low. Click again to lock it in. Now watch what happens next. As price pulls back, it doesn't move randomly. It often retraces to key levels, like the 38.2% Fibonacci level, before continuing in the direction of the trend. The market retraces, but the trend remains, and Fibonacci helps you see where it might turn. So, why does Fibonacci actually work? Is it some kind of magic number? Not exactly. Its human psychology markets are driven by people, and people tend to behave in patterns. When price moves strongly, traders don't usually jump in at the top. They wait for a pullback, and very often, that pullback happens around familiar levels like 38.2%, 50%, or 61.8%. Here's where it gets interesting. Millions of traders around the world are watching the same Fibonacci levels. So when price reaches those levels, buyers step in, sellers react, and the market moves. Fibonacci simply gives us a framework to measure those pullbacks. Fibonacci doesn't predict the market. It reveals where people are likely to react. To summarize, in this video, we explored what Fibonacci is and how this simple mathematical sequence appears not just in nature and art, but also in the financial markets. We looked at how Fibonacci shows up on charts, helping us identify potential pullbacks and reaction levels. We also learned how to set up Fibonacci retracement properly. Then we uncovered the key Fibonacci levels, like 38.2%, 50%, and 61.8% that traders around the world are watching. And finally, we answered the most important question. Why does Fibonacci actually work? Not because it's magic, but because of human psychology, and the fact that so many traders are reacting to the same levels. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.